Look, I really did not want to make a new video today. It is December 26th. I should be with my family. I told myself I would ignore the markets for 24 hours, but I lied. I looked at my phone, and what I saw forced me to come down here and hit record. Because something broke in the global financial system while we were sleeping. And if you have any money in the markets, or if you are holding any silver, you need to see this right now. Not tomorrow. Right now. Put down the leftovers. Stop scrolling. Because what is happening in Shanghai is not a glitch. It is a mathematical impossibility. And it is going to change the opening price in New York forever. I want you to take out your phone, open your brokerage app, look at the price of silver in New York. What do you see? $71.80, right? It looks calm. It looks boring. Now, look at this. This is the closing price from the Shanghai Futures Exchange a few hours ago. $80.53. Do you see the problem? That is a difference of $9. That is a 12% premium. In the professional trading world, we do not call this a spread. We call this a broken market. Now, I know the skeptics are already typing in the comments. Oh, Asian guy, you are making up numbers. That is just the exchange rate difference. Stop. Let us do the math together right now. Get your calculator out. I will wait. Take the Shanghai price, 18,145 yuan per kilogram. Divide by the exchange rate of 7.006. That gives you $2,589 per kilo. Now divide by 32.15, because silver is measured in troy ounces. The result is $80.53. The math is undeniable. The largest manufacturing economy on Earth, the country that actually uses the silver to build the world's electronics, is saying silver is worth $80, while Wall Street is pretending it is worth $71. So, here is the question that should be keeping you awake tonight. If silver is $9 cheaper in New York, why are the banks not buying it here and selling it there? Why is JP Morgan not backing up a 747 cargo plane to the JFK vaults, loading it with cheap silver, flying it to Shanghai, and making a risk-free $9 billion profit? It is free money. It is the easiest trade in the history of finance. So why are they not doing it? There is only one answer. And it is terrifying. They can't. They cannot move the metal, because the metal is not there, or if it is there, it is already spoken for. To understand why this is happening, you have to understand the mechanics of the silver market. Usually, arbitrage keeps the price in check. If London is 50 cents cheaper than New York, algorithms buy London and sell New York instantly. It takes milliseconds, but that is for paper contracts. To close a $9 gap, you cannot use paper. You need physical bars. You need 1,000-ounce good delivery bars. And you need to physically fly them across the ocean. We have been tracking the inventory reports. Look at this. On December 23rd, just before the holiday, the Asahi refinery vault in New York saw a massive withdrawal. 1.4 million ounces. Withdrawn. Gone. In a single day. Do you realize how much metal that is? That is roughly 43 metric tons. You cannot put that in a briefcase. You need armored trucks. You need a convoy. That was not a bank shuffling paper. That was not a hedge fund hedging a position. That was a truck backing up to the loading dock and taking physical possession. The bridge between New York and Shanghai has collapsed. The paper market and the physical market have officially divorced, and New York is the ex-husband who does not know he has been dumped yet. You need to understand who is on the other side of this trade. Who is paying $80 in China? It isn't retail traders like you and me. It isn't speculators on Reddit. I was reading a report last night that nobody in the mainstream media is talking about. It is about the new Samsung solid-state batteries. You might have seen the headlines. 600-mile range, 9-minute charge. It sounds great for the consumer, but for the silver market, it is a nuclear bomb. Here is the secret sauce. The anode in these new batteries is a silver-carbon composite. These cars do not use grams of silver like a Tesla. A standard electric vehicle uses maybe 20 to 50 grams for contacts and switches. But these new solid-state batteries, they use kilograms, up to 1,000 grams per car. Now put yourself in the shoes of a CEO at BYD or CATL in China. You have a factory to run. You have to build 5 million cars next year to beat Elon Musk. You look at the vaults in London and New York, and you see them running dry. You see the mining supply flatlining. Do you care if the price is $70 or $80? No, you care about zero. Because if you get zero silver, your factory closes, your workers go home, your company dies, so you panic buy. You pay $80, you pay $90, you pay whatever it takes to secure the metal. This is not speculation. This is an industrial bank run. They are draining the world's supply before the news hits the mainstream. They are playing musical chairs, and right now China is buying all the chairs. And it is not just cars. For years the analysts told us, oh, don't worry about solar panels. They are using less silver. They called it thrifting. They said copper would replace silver. That was a lie. There is an economic principle called Jevons paradox. It states that as technology increases the efficiency with which a resource is used, the total consumption of that resource increases rather than decreases. Why? Because if solar panels become more efficient and cheaper to make, we don't make fewer of them. We make millions more of them. I have the data here from the latest solar industry report. The industry is shifting to a new technology called TOPCon. I won't bore you with the chemistry, but here is what matters. The old PERC cells used silver only on one side. TOPCon cells are bifacial. They require pure silver paste on both sides, and they use 50% more silver than the old panels. China controls 80% of the solar market, so you have the solar giants panic buying. You have the EV giants panic buying. And you have no new mines coming online for 10 years. Mining is not software. You cannot code a new mine. It takes 10 years to find the deposit, get the permits, build the infrastructure, and dig the hole. Even if silver goes to $200 tomorrow, the supply will not increase until 2035. This is why the price in Shanghai is $80. It is the real price of physical scarcity. New York is pricing a paper derivative. Shanghai is pricing the actual metal. And in a fight between paper and rock, rock wins every time. And that brings me to why I am making this video right now, why I couldn't wait until January. Tomorrow morning, the US markets reopen. We call this time of year Ghost Week. It is the days between Christmas and New Year. The volume is dead. Liquidity is dry. The senior traders at Goldman Sachs and Morgan Stanley are skiing in Aspen. The trading desks are being run by junior interns and automated algorithms. But the algorithms do not know it is Christmas. They only see data. And tomorrow morning, the algorithms are going to wake up and see that $9 gap. Equation A says $80. Equation B says $71. The code has one instruction: buy B until it equals A. Usually, a human risk manager would step in. They would say, wait, we cannot buy New York silver because we cannot ship it to China. The vaults are empty. The logistics are broken. But the humans are gone. The humans are on vacation. So we are staring down the barrel of an air pocket. If a big buy order hits New York tomorrow morning, there are no sellers. The order book is paper thin. On a normal day, there might be 500 contracts for sale at $71.50. Tomorrow there might be 50. It takes very little money to move the price a very long way. The price could skip. It could go from 71 to 75 in the blink of an eye. Or the banks might try one last smash. They might dump $1 billion of paper silver into the vacuum to try and break the momentum. It is going to be volatile. It is going to be violent. And if you are not prepared, you are going to get wrecked. There is another technical factor that nobody is talking about. It is called gamma. The banks have sold thousands of call options to speculators at the $72 and $75 strike prices. These are bets that the price will go up. The banks took the other side of the bet. If the price stays below $72, the banks keep the premium and make a profit. But if the price gaps up to $75 tomorrow morning, the banks are in trouble. They are offside. To protect themselves, their automated risk engines have to hedge. How do they hedge? They have to buy futures contracts. So, as the price rises, the banks are forced to buy more to cover their losses. But buying more pushes the price higher, which forces them to buy even more. It is a feedback loop from hell, and it is happening in a market with no inventory to slow it down. This is exactly how the GameStop squeeze happened. But this isn't a video game retailer. This is the strategic metal that powers the modern economy. So, listen to me. This is the most important part of this video. This is where I need you to focus. When you see the price rip, when you see your account balance jump next week, your brain is going to play a trick on you. You have been conditioned for 40 years. You have been beaten down by the banks. You have battered bull syndrome. You think $30 is expensive. You think $50 is the all-time high. So when you see $80 on the screen, your brain is going to scream at you. Sell. Take the money. It is a bubble. Get out before it crashes. Do not do it. I am begging you. Do not let them shake you out. Think about it. If you sell your physical silver at $80, what are you getting in return? You are getting fiat currency. You are getting dollars. The very thing that the Federal Reserve just admitted they have to print into oblivion to save the bond market. You are trading a strategic asset that Samsung and BYD are fighting over for a liability that is losing value every single day. That is not taking profit. That is jumping off the lifeboat to swim back to the Titanic because the band is playing a nice song. $80 is not the ceiling. $80 is the floor. It is the new cost of doing business in a world without inventory. If you sell now, you will never get your position back. The Chinese buyers are price inelastic. That means they don't care about the price. They need the metal. If you sell your stack, it flows east, and it never comes back. You might think, but the regulators will fix it. The government won't let the price explode. Really, let me remind you what happened in March 2022. The nickel market. The London Metal Exchange. A massive short squeeze happened. A Chinese tycoon known as Big Shot was shorting nickel. The price doubled in a few hours. It went vertical. It went from $25,000 to $100,000 a ton. Did the exchange pay the winners? Did they let the free market work? No. They cancelled the trades. They literally turned off the computers and deleted the transactions. They said, "This trading day never happened." They protected the banks and they screwed the retail investors who were long. We are seeing the same setup in silver right now. The banks are trapped in a short position they cannot cover. If silver goes to $100, some major banks are insolvent. Do you think they will play fair? No. They will change the rules. They will try to force you to settle for cash. This is why you must hold the physical metal. If you hold a paper contract, you are just an unsecured creditor. If you hold the metal, you are your own central bank. When the music stops, paper contracts will be settled in devalued currency. Only the people holding the bar will have the wealth. We are rapidly approaching a phase I call unobtainium. This is when the price on the screen becomes irrelevant, because you cannot buy anything at that price. It is like looking at a real estate website. Zillow might say a house is worth $500,000, but if the owner refuses to sell, that price is fiction. Go to the major online dealer websites right now. Look at the inventory for 100-ounce bars. Look at the sovereign coins like eagles and maples. You will see a lot of out-of-stock labels. You will see pre-order only. Delays of 4 weeks, delays of 8 weeks. The premiums are already rising. In January, that delay could go to indefinite. Imagine waking up, seeing silver at $100, wanting to buy, and realizing the buy button is gone. That is the moment the paper price dies. If you have cash on the sidelines, do not try to be cute. Do not try to time the dip next week. Do not try to save 50 cents. If you can find metal available for immediate delivery, secure it. Because once the Ghost Week gap closes, the retail stampede is going to clear out whatever inventory is left. I am going back to my family now. I need to finish my Christmas leftovers. But I wanted to get this message out to you because the window is closing. The arbitrage is broken. The era of the Western discount is over. New York has lost control. Shanghai is the captain now, and Shanghai is hungry. Keep your eyes on the screen tomorrow morning. Watch the spread. If New York opens flat, it is a trap. If New York gaps up, the squeeze is on. Stay strong. Hold your position. Do not sell your future for paper promises. Good luck, everyone. I will see you on the trading floor.